Introduction to Overseas Property Investment. Investing in property overseas presents a unique opportunity for diversification and potential high returns, attracting many individuals seeking new avenues for wealth growth. This venture can offer exposure to different economic cycles and rental markets, potentially stabilizing an investment portfolio against domestic fluctuations. However, it also introduces a distinct set of challenges, including navigating unfamiliar legal systems, cultural differences, and varying market dynamics. Understanding both the allure and the complexities is crucial for any prospective international buyer. This course will equip you with the knowledge to approach such investments strategically, mitigating risks while maximizing potential rewards. It covers everything from initial market research to long-term management and exit strategies. Prepare to explore the exciting world of global real estate investment with a clear, informed perspective. Why invest overseas? Diversification is a primary driver for many investors looking beyond their domestic borders, as it helps spread risk across different economic environments. Investing in a foreign market can provide access to higher growth potential in emerging economies or more stable returns in mature markets. It also offers the chance to capitalize on favorable exchange rates, potentially increasing purchasing power or future returns. Furthermore, owning property in another country can serve as a lifestyle investment, providing a vacation home or a future retirement residence. Some investors are also motivated by the prospect of obtaining residency or citizenship through property investment programs, often referred to as golden visas. These combined factors make overseas property an attractive proposition for a diverse range of financial and personal goals. Initial market research and due diligence. Thorough market research is the cornerstone of a successful overseas property investment, requiring a deep dive into potential locations. Begin by analyzing economic indicators such as GDP growth, inflation rates, and employment figures, which provide insights into a country's financial health and stability. Investigate local property market trends, including price appreciation, rental yields, and vacancy rates, to gauge investment viability. Consider demographic shifts, infrastructure development plans, and tourism statistics, as these can significantly impact future property values and rental demand. Utilize reputable international real estate portals, local government statistics, and economic reports to gather comprehensive data. This meticulous approach helps identify markets with strong growth potential and minimizes exposure to unforeseen risks. Remember, a well-researched decision is a well-protected investment. Understanding local economies. A deep understanding of the local economy is paramount when considering overseas property, as it directly influences investment performance. Investigate the primary industries driving the local economy, such as tourism, manufacturing, or technology, and assess their stability and growth prospects. Analyze government policies related to foreign investment, property ownership, and economic development, as these can create both opportunities and restrictions. Evaluate the local job market and income levels, which directly impact rental demand and affordability for potential tenants. Furthermore, consider the political stability and regulatory environment, as sudden changes can significantly affect property values and investor confidence. Engaging with local experts, such as economists or business consultants, can provide invaluable insights into these nuanced economic factors. A robust local economy typically translates to a more secure and potentially profitable property investment. Legal frameworks and regulations. Navigating the legal frameworks of a foreign country is one of the most critical and complex aspects of buying property overseas. Each nation has its own unique set of property laws, ownership structures, and transfer procedures, which can differ significantly from your home country. It is essential to engage a local, independent lawyer who specializes in international property transactions and speaks your language, or at least has a translator. They will conduct thorough due diligence, verify ownership, check for encumbrances, and ensure all contracts comply with local regulations. Understanding local zoning laws, building codes, and environmental restrictions is also vital, as these can impact your ability to develop or modify the property. Failure to adhere to these legal requirements can lead to significant financial losses and protracted disputes. Always prioritize legal counsel to safeguard your investment. Buyer protection and rights. Understanding your rights as a foreign property buyer is crucial for protecting your investment and ensuring a smooth transaction. Different countries offer varying levels of buyer protection, from robust consumer laws to more limited safeguards. Your local legal counsel will be instrumental in explaining these rights, including cooling-off periods, deposit protection schemes, and recourse in case of developer default or contractual breaches. Some jurisdictions have specific laws governing foreign ownership, such as restrictions on certain types of property or requirements for local partners. It is important to clarify whether you will have the same rights as a local citizen, or if there are specific provisions for non-residents. Always ensure that all agreements are in writing, legally binding, and fully understood before signing. Due diligence extends to verifying the reputation of all parties involved, including developers, agents, and lawyers, to minimize the risk of fraud or misrepresentation. Taxation implications overseas. Taxation is a significant consideration when buying property overseas, as it can substantially impact the overall profitability of your investment. You will likely encounter various taxes, including property purchase taxes, annual property taxes, rental income tax, capital gains tax upon sale, and potentially inheritance tax. It is crucial to understand the tax laws in the country where you are buying, as well as how they interact with your home country's tax regulations. Many countries have double taxation treaties to prevent individuals from being taxed twice on the same income or capital, but the specifics vary widely. Engaging a tax advisor specializing in international property is indispensable to navigate these complexities, optimize your tax position, and ensure compliance. Failure to properly account for taxes can lead to unexpected costs and legal penalties. Always seek expert advice to avoid costly oversights. Double taxation treaties, DTTs, are bilateral agreements between two countries designed to prevent individuals and companies from being taxed twice on the same income or capital. These treaties specify which country has the primary right to tax certain types of income, such as rental income or capital gains from property sales. Understanding the DTT between your home country and the country where you are investing is vital for effective tax planning. Your international tax advisor will analyze the specific clauses of the relevant treaty to determine your tax obligations and potential reliefs. DTTs can provide mechanisms for tax credits or exemptions, significantly reducing your overall tax burden. However, the interpretation and application of these treaties can be complex, requiring expert guidance. Always verify the existence and details of any applicable DTT to optimize your tax strategy and avoid unexpected liabilities. Currency exchange risks. Currency exchange rate fluctuations pose a significant risk when buying property overseas, impacting both the initial purchase price and future returns. A strengthening local currency against your home currency can make the property more expensive to buy, while a weakening currency can reduce the value of your rental income or sale proceeds when converted back. These fluctuations are unpredictable and can erode potential profits or even lead to losses. It is crucial to monitor exchange rate trends and consider strategies to mitigate this risk. Hedging instruments, such as forward contracts or currency options, can lock in an exchange rate for a future transaction, providing certainty. However, these instruments come with their own costs and complexities. Always factor currency risk into your financial projections and seek advice from a foreign exchange specialist. Understanding this volatility is key to protecting your investment's value. Financing overseas property. Securing financing for an overseas property can be more challenging than a domestic purchase, requiring careful consideration of available options. You generally have two main routes: obtaining a mortgage from a local bank in the target country, or seeking an international mortgage from a global lender. Local banks often require you to have a local bank account, a significant deposit, and may have stricter lending criteria for non-residents. International lenders might offer more flexible terms, but could have higher interest rates or fees. It's crucial to compare interest rates, loan-to-value ratios, repayment terms, and associated costs from various providers. Be prepared for extensive paperwork and potentially longer approval processes. Some countries also have restrictions on foreign borrowing or require proof of funds from your home country. Always consult with a financial advisor specializing in international mortgages to explore the best financing solution for your specific situation. Understanding these nuances is key to a successful purchase. Property types and ownership structures. Understanding the different property types and ownership structures available in your target country is fundamental to making an informed investment decision. Common ownership types include freehold, where you own both the land and the building outright, and leasehold, where you own the building for a fixed period, but not the land. Some countries offer unique structures like fractional ownership, allowing multiple individuals to own a share of a property, or usufruct, granting the right to use and enjoy property without owning it. The choice of ownership structure can have significant implications for your rights, responsibilities, and future resale options. Additionally, consider whether to purchase the property in your individual name, through a local company, or via an offshore entity, as each option has distinct legal and tax consequences. Your local lawyer will advise on the most suitable structure based on your objectives and the country's laws. This decision impacts everything from tax liabilities to inheritance planning. The overseas property purchase process. The process of purchasing property overseas can vary significantly from country to country, often involving unique steps and requirements. Typically, it begins with making an offer, often accompanied by a small reservation deposit. Once the offer is accepted, a preliminary contract, sometimes called a memorandum of understanding or pre-contract, is signed, and a larger deposit is usually paid. This stage is critical for legal due diligence, where your lawyer verifies all aspects of the property and seller. Following successful due diligence, the final purchase agreement is signed, and the remaining balance is transferred. The property is then registered in your name with the local land registry, a process that can sometimes take several weeks or months. Throughout this process, engaging a reputable local real estate agent and an independent lawyer is paramount to ensure all steps are followed correctly and your interests are protected. Be prepared for potential delays and ensure all financial transactions are transparent and documented. Hidden costs of buying overseas. Beyond the advertised purchase price, several hidden costs can significantly impact the total investment when buying property overseas. These often include various taxes, such as stamp duty, transfer taxes, and value-added tax, VAT, on new builds, which can amount to a substantial percentage of the property value. Legal fees for your lawyer, notary fees, and real estate agent commissions are also standard expenses. Additionally, budget for property registration fees, land registry charges, and potential translation costs for documents. Post-purchase, ongoing expenses like annual property taxes, utility connection fees, insurance premiums, and maintenance costs for common areas, if applicable, must be considered. If you plan to renovate, factor in local labor costs and material availability, which can differ greatly. Always request a detailed breakdown of all anticipated costs from your agent and lawyer before committing to a purchase. Overlooking these can lead to unexpected financial strain. Managing your overseas property. Effective management of your overseas property is crucial, especially if you do not reside in the country full-time. Options range from self-management, which requires significant time and local knowledge, to hiring a professional property management company. A good property manager can handle everything from tenant screening, rent collection, and maintenance, to dealing with local authorities and ensuring legal compliance. They are invaluable for bridging language and cultural barriers. When selecting a management company, research their reputation, experience with foreign owners, fee structure, and the services included. Clearly define their responsibilities and your expectations in a written contract. consider the logistics of property access for maintenance or emergencies, and establish clear communication channels. If you plan to use the property as a vacation rental, explore local short-term rental regulations and platforms. Proper management ensures your investment remains profitable and hassle-free. Exit strategies for overseas property. Developing a clear exit strategy is as important as the initial investment decision when buying property overseas. This involves considering how and when you plan to sell the property, and what factors might influence its resale value. Research the local real estate market's liquidity, average time on market for similar properties, and typical transaction costs for sellers. Be aware of any capital gains taxes in the foreign country and how they interact with your home country's tax laws. Currency exchange rates at the time of sale can significantly impact your net proceeds when converted back to your home currency. Consider potential restrictions on repatriating funds from the sale. Engage a local real estate agent with a strong track record in selling to international buyers. Having a well-defined exit plan helps you maximize your return on investment and avoid being forced into a disadvantageous sale. It's about planning for the end from the beginning. Political and economic stability. Assessing the political and economic stability of a country is paramount before making an overseas property investment, as instability can severely impact your asset's value and your ability to manage it. Research the current political climate, including government stability, electoral processes, and the risk of civil unrest or policy changes that could affect foreign investors. Evaluate the country's economic outlook, looking at factors like inflation, interest rates, and GDP growth forecasts, as these directly influence property market performance. Consider the legal and regulatory environment for foreign ownership, ensuring it is robust and transparent. Geopolitical events, trade wars, or changes in international relations can also have ripple effects on local markets. Diversifying across politically stable regions can mitigate some of these risks. Always stay informed through reputable international news sources and expert analyses. A stable environment provides a more secure foundation for your investment. Cultural and language barriers can present unexpected challenges when buying and managing property overseas, potentially leading to misunderstandings or delays. Communication is key, and even if you find professionals who speak your language, nuances in local customs, business etiquette, and legal terminology can be tricky. Research the local culture thoroughly to understand social norms, negotiation styles, and expectations in business dealings. Learning basic phrases in the local language can significantly enhance your experience and build rapport, even if you rely on translators for official matters. Be patient and adaptable, recognizing that processes may differ from what you are accustomed to. Engaging with local communities and seeking advice from expatriates can provide valuable insights. Overcoming these barriers fosters smoother transactions and more effective property management, ensuring a more positive overall investment journey. Embrace the differences as part of the international experience. Visa and residency implications. For many, buying property overseas is intertwined with the desire for visa or residency benefits, making it a critical aspect to research. Several countries offer golden visa or residency by investment programs, which grant residency rights in exchange for a significant property investment. These programs often come with specific requirements regarding the investment amount, property type, and duration of ownership. It is essential to understand the eligibility criteria, application process, and the rights conferred by such a visa, including freedom of movement, work permits, and access to public services. Consult with an immigration lawyer specializing in these programs to ensure compliance and avoid pitfalls. Be aware that these programs can change due to political shifts. Even if you do not seek residency, understand the rules for extended stays as a property owner. Clarifying these implications early on can align your investment with your long-term personal and lifestyle goals. Insurance for overseas property. Adequate insurance coverage is indispensable for protecting your overseas property investment against unforeseen events and liabilities. Research the types of insurance available in the local market, which typically include building insurance, contents insurance, and liability insurance. Building insurance covers structural damage from events like fire, flood, or storms, while contents insurance protects your personal belongings within the property. Liability insurance is crucial for covering claims from accidents that occur on your property. Consider additional coverage for specific risks prevalent in the region, such as earthquake insurance in seismic zones or hurricane insurance in coastal areas. It is advisable to obtain quotes from multiple local providers and compare their coverage, deductibles, and exclusions. Ensure the policy is in English or professionally translated and that you understand the claims process. Protecting your asset with comprehensive insurance provides peace of mind and financial security. Do not underestimate the importance of this safeguard. Succession and inheritance planning. Succession and inheritance planning for overseas property requires careful attention, as local laws can differ significantly from your home country's regulations. Many countries operate under forced heirship rules, which dictate how property must be distributed among heirs, regardless of your will. This can override your wishes if not properly addressed. It is essential to consult with a local lawyer specializing in international estate planning to understand the applicable laws and create a valid will in the foreign jurisdiction. Consider the implications of inheritance taxes, which can vary widely and impact the value passed on to your beneficiaries. Explore options like holding the property in a trust or a company, which can sometimes simplify succession and reduce tax burdens. Failure to plan adequately can lead to complex legal battles, significant delays, and unexpected costs for your heirs. Proactive planning ensures your legacy is handled according to your intentions. Environmental risks. Environmental risks are an increasingly important consideration when investing in property overseas, as climate change and natural disasters can significantly impact property values and safety. Research the susceptibility of your chosen location to specific environmental hazards such as floods, earthquakes, wildfires, hurricanes, or rising sea levels. Investigate local building codes and infrastructure resilience in the face of these risks. Consider the long-term environmental trends and how they might affect the desirability and insurability of your property. For example, coastal properties might face erosion or increased storm intensity. Obtain environmental surveys or assessments if available, and consult with local experts on geological stability or climate projections. Understanding these risks allows you to make informed decisions, choose a resilient location, and ensure adequate insurance coverage. Prioritizing environmental due diligence protects your investment from nature's unpredictable forces. Fraud and scams. The risk of fraud and scams is unfortunately heightened when buying property overseas, especially in unfamiliar markets, making vigilance essential. Common scams include properties being sold by individuals who are not the legal owners, properties with undisclosed encumbrances or debts, or developers selling units that do not exist or will never be completed. Be wary of deals that seem too good to be true, high-pressure sales tactics, or requests for large cash payments. Always verify the identity of all parties involved, including agents, developers, and sellers, through official channels. Insist on using an independent local lawyer for all legal checks and transactions, and never transfer funds without their explicit approval. Avoid relying solely on online information, conduct physical visits, and verify all documentation. Educate yourself on common local scam tactics. Protecting your investment from fraud requires meticulous due diligence and a healthy dose of skepticism. Trust your instincts and seek expert advice. Due diligence checklist. A comprehensive due diligence checklist is an indispensable tool for systematically evaluating an overseas property investment and mitigating risks. This checklist should cover legal aspects, such as verifying title deeds, checking for liens or encumbrances, and understanding local zoning laws. Financial due diligence includes assessing property value, rental yields, potential capital gains, and all associated taxes and fees. Market research involves analyzing economic stability, growth prospects, and local property trends. Practical considerations include inspecting the property's physical condition, assessing access to utilities, and understanding local infrastructure. Always verify the reputation and credentials of all professionals involved, including real estate agents, lawyers, and developers. Ensure all contracts are reviewed by your independent lawyer before signing. This structured approach helps ensure no critical step is overlooked, providing a robust framework for making informed decisions. A thorough checklist is your best defense against unforeseen problems. Case studies, success stories. Examining real-world success stories can provide valuable insights and inspiration for your overseas property investment journey. These case studies often highlight investors who identified emerging markets early, capitalized on favorable exchange rates, or successfully navigated complex legal systems. For instance, an investor might have purchased a holiday rental in a rapidly developing tourist region, benefiting from strong rental yields and significant capital appreciation over time. Another success could involve an investor who bought a distressed property, renovated it thoughtfully, and sold it for a substantial profit, leveraging local expertise. These examples often underscore the importance of thorough research, patience, and engaging the right local professionals. They demonstrate how strategic planning and a deep understanding of the local market can lead to substantial financial rewards. Learning from these triumphs helps build confidence and refine your own investment approach. Success leaves clues for those willing to study them. Case studies, pitfalls and failures. Learning from the mistakes of others is equally important as studying successes, providing crucial lessons in risk avoidance when investing overseas. Case studies of pitfalls often reveal instances where investors failed to conduct adequate legal due diligence, leading to disputes over ownership or undisclosed debts. Others might have underestimated the impact of currency fluctuations, eroding their returns, or neglected to factor in high maintenance and taxation costs, turning a seemingly good deal into a financial burden. Political instability or sudden changes in foreign ownership laws have also led to significant losses for some investors. These examples highlight the dangers of rushing into decisions, relying on unreliable advice, or failing to understand local market specificities. They underscore the necessity of comprehensive research, independent legal counsel, and a cautious approach. By understanding common pitfalls, you can proactively implement strategies to protect your investment and avoid similar costly errors. Prevention is always better than cure in international real estate. Leveraging technology for research. Modern technology offers powerful tools to streamline your overseas property research, making it more efficient and comprehensive. Utilize international real estate portals and listing websites that aggregate properties from various countries, providing extensive filters for location, price, and property type. Data analytics platforms can offer insights into market trends, price history, and rental yields, helping you identify promising investment areas. Virtual tours and high-quality photography allow you to inspect properties remotely, saving time and travel costs in the initial stages. Online forums and social media groups dedicated to expatriates or international investors can provide real-time advice and personal experiences. However, always cross-reference information from multiple sources and verify details with local professionals. While technology enhances access to information, it should complement, not replace, traditional due diligence and expert advice. Use these tools wisely to empower your decision-making process.